In this class we'll deal with marginal costing. Now you'll see from the bottom right hand corner of the slide there are 90 slides in this talk, so it's quite a long one. It would be well advisable on your part to take a break every so often, freeze the video, take a break, do something else, make some notes and come back to it and complete it. It's not wise to attempt to run through all of this video in one move. So perhaps study some parts of it, go back, study some more and get through it that way. But remember to make notes as you go through. It's always advisable to make your own notes and have them in a form that's easily accessible for revision purposes. So let's start by looking at the idea of relevant cost and decision making. Now management may change the level or method of activity so as to improve the financial performance of the business. In fact, management are constantly looking into ways in which the activities of the business can be changed and altered and improved. And these of course will have an impact on costs and on the finances of the business, and hence of course will come under the scrutiny of the cost and management accountants. Costs that are important are the ones that will alter as a result of management's decision. So when management changes something, it's the costs that change that are relevant. Some costs will not change, some will. It depends on what they've decided to do. So when management make a decision, some costs may change, some may not, and it's important to be able to identify these costs and look at the implications of the decision in terms of costs and how it will affect the overall costing position of the business. This introduces the idea of relevant costs. Now relevant costs are all the costs that will be affected by management decisions. These costs are an important element and must be considered as they can make a huge impact to the overall decision of the business. So relevant costs are all the costs that will be affected by management decisions. These are relevant. Other costs are not relevant. So take an example. If the management decides to change the design of a product, perhaps just change it slightly, nonetheless they're changing it, that will have an impact on the materials that are used. It may have an impact on the tooling that is used for the machines that make the product. But the overall factory cost, the rent of the factory, that will not be affected. So some items of cost are fixed, some items are variable. And it's important to know what costs are relevant in decision making. When decisions are being made about changing something, some costs are relevant, some costs have to be taken into account. Other costs don't make an impact, don't change. So other costs do not alter despite the decision made by management, and these are called non-relevant costs. Non-relevant costs. So we have this distinction now between relevant costs, costs that do change as a consequence of a change in decision, and non-relevant costs, the costs that do not change. Let's look at non-relevant costs again for a moment. These costs do not change despite the decision-making process. For example, sunk or past costs. This is money spent which cannot be recovered. It's sunk. It's spent, so it can't be recovered, it can't be changed, it can't be undone. An example may be where expenditure has been incurred in developing a new product. Well, once the expenditure is made in developing the new product, it can't be unspent, it can't be redeemed. It's a sunk cost. The hope is that the product will be successful and that the investment in developing the new product will be recouped as a consequence of its success. But in terms of the actual expenditure, that's a sunk cost. That has been spent, that's been used. There's nothing the business can do it's gone. The money has been spent on this product, and if management decides to abandon further developments of the product, the expenses incurred cannot be recovered. So if the management decide against the further development of this particular product, then any money spent up to that point is gone. It's sunk. It's a past cost. Therefore, the cost is irrelevant to any future decisions taken in regards to the product. So sunk costs are sunk. They're in the past. They should not affect present decisions. The business has to deal with what it's got now, and deal what it's confronting. Deal the changes in the market, deal with the changes in technology, deal with the current issues. It can't go back to a decision that it made in a previous time period, and perhaps a bad decision, but that's a sunk cost. It's gone. So it's not relevant anymore. It should not be taken into account. Non-relevant costs. Well, these costs do not change despite the decision-making process. Fixed costs are irrelevant to decision-making because these costs do not change despite the level of activity. They're fixed. So the management may decide to produce a lot or a little. It's still faced with a fixed cost. It's fixed. It doesn't vary with the level of output. So it's not relevant in decision-making. The management may recognize the existence of the fixed costs, but it can't do anything about them. So these costs are not seen as relevant. They shouldn't be really taken into account in decision making. Sometimes the cost of overheads absorbed by a particular cost unit may alter due to certain decisions. However, this mainly depends on the company's cost accounting procedures for overheads. So sometimes overheads can be absorbed in the sense that the management accountants know what the overheads of various parts of the business are, and they can work out what proportion of the costs can be allocated to the product to cover those overheads. The product makes a contribution, in other words, towards the overheads of the business. But the overheads are, by and large, fixed costs. They are the ones that do not vary with the level of output. The company may produce a lot or a little, but it will still perhaps have the same marketing department, the same number of people. It'll still have the same number of receptionists, same number of accountants. These are fixed, irrespective of the level of output. Of course, if the company's not generating profits and is facing a bad market situation, then the company may have to make redundancies amongst some of those staff, thereby trying to reduce that particular fixed cost. If the cost of overheads incurred does not change, the overhead is not a relevant cost. So overheads tend to be fixed, and therefore, in a sense, they're not taken into account. They're not relevant. What's relevant is the cost of production, the cost of making the product, and the markup that's added to the costs, which is the contribution to the overheads. And later on, a contribution to the profits once the overheads are paid. These costs do not change despite the decision-making process. That's the point to bear in mind. Now, committed costs. Well, this is the expenditure which will be incurred in the future as a result of decisions taken in the past and which cannot be changed. Sometimes companies commit themselves to a certain course of action. They can't change it. Perhaps there's a contractual agreement with another company to do something. That's committed, and the costs are committed. The company has to honour what it said, so it's fixed. Committed costs are fixed. They're not relevant for decision making. The company simply has to pay what it said. Committed costs will occur despite any decision taken by management, therefore they are not relevant costs. The committed costs will occur. They're committed. The company has made a decision in the past, made a commitment, and it must honour the commitment. It's a fixed cost. So they're not relevant in decision making. An example could be expenditure on raw materials for a product where the materials have been delivered but not yet paid for. That's a committed expenditure. The company may have purchased raw materials, made a commitment to buy those raw materials. The raw materials have been delivered to the company, but they have to be paid for in the future. There's a contract, there's an obligation, there's a moral obligation, in fact, to pay for what it receives. Those are committed costs. So, but those, in a sense, do not enter into any decision-making process because there's nothing the decision maker can do about those. They are fixed. The company have to pay for the materials purchased regardless of whether they use the materials for the product or not. Therefore, it's not a relevant cost. The company has bought in raw materials. Whether the company uses those or not is broadly irrelevant in terms of the commitment to pay. It still has to pay for them. Take an example. The salary to be paid to, say, a product developer who will manage a new product. Let's say it's a new position in the company and carries a salary of, say, £50,000 a year and is a fixed cost. So this product developer or product manager gets £50,000 a year. Now, this cost is relevant to the decision taken to proceed with. Now, the question is, I should say, is it relevant to the decision to proceed with the development of the new product? Is the cost relevant? Well, the solution: the salary of £50,000 is a relevant cost. However, it does say that the salary is a fixed cost. So the cost may be fixed in total, but it is a cost which is relevant in the decision to proceed with the development of the new product. This is also known as directly attributed or attributable fixed costs. So it is a relevant cost, but having made the decision to develop the new product, perhaps the fixed cost element could be considered, that this is a fixed cost. Once the decision to go ahead with the new product is made, then they're going to need this product developer, and the product developer needs £50,000. So it's, in that sense, it's a fixed cost. But it's relevant if the product developer wanted £100,000, it may mean that the business would not consider developing this product. It was too expensive. So it would be relevant. So the salary is relevant as to whether the product is developed from the start or not. Management are considering the purchase of a new machine to manufacture one of the company's established products. The new machine will incur additional running expenses of £8,000 a month. The new machine will save labour time, and the fixed overheads to be absorbed by the product will be reduced by £380 monthly. Are these costs relevant to the decision to buy the new machine? Well, should they be taken into account in the decision-making process as to whether to buy this machine or not? Well, the £8,000 running cost of the machine is relevant to the decision to buy the machine because this cost is directly related to the machine. So certainly the additional running cost or running expenses of £8,000, that is relevant, and that should be taken into account. However, the savings on overhead absorption is not relevant because we are not told whether the total overhead expenditure will be altered. So we don't know if total overheads will be changed as a consequence of buying this machine. So we're not sure if this new machine, that information should be taken into account. But the savings in labour costs would be relevant in the decision-making process. The new machine will save labour time, and the fixed overheads to be absorbed by the product will be reduced by £380 a month. So the labour element, now that is important because labour goes with the machine. The machine needs workers to work with the machine, to perhaps feed the material into the machine, to maintain the machine, to ensure that it's properly tooled up to do the job. Now, marginal costing. Well, marginal costing is an accounting system used to help management in decision making. The main elements in marginal costing is to separate both variable and fixed costs. So when we think of marginal costing, we should immediately think about separating out fixed and variable cost. Seeing what costs are fixed, what costs are variable. That's our first port of call. That's what we should do initially. Marginal costing is not a costing method such as job costing or process costing. Instead, it's simply it's a method to analyze cost information for management so that they can understand how profit is affected due to changes in the volume of output. So marginal costing is, in a sense, looking at the cost of a particular product. How much does it cost to make that product? In other words, we're not looking at the fixed elements of cost, we're looking at the variable cost. How much does it cost to make that particular product? Because the fixed costs are not relevant. They're there anyway. But the variable cost, how much raw material is in the product? Perhaps how much labor does it take to make the product? How much energy does it take to make the product? Add up all of the variable costs for that product, and that should be taken into account. Because then the more that's produced, the greater the volume of output, the more that this product will generate for the firm. Assuming, of course, that having worked out what we call the marginal cost of the product, there is an appropriate markup added to that, which is compatible with good sales in the marketplace. So the markup plus the marginal cost will equal the price, and the price should be competitive in the marketplace to enable sales to take place. But the more sales there are, the more this markup on the marginal cost will come into play. We will eventually cover the overheads of the business and will eventually start to generate a profit for the business. The main focus in marginal costing is on variable costs such as direct labour, direct materials, direct expenses, and the variable parts of the overheads, if there are variable parts to the overheads. This is then allocated to each cost unit. So marginal costing is looking at the production of a particular product and asking how much does it cost to make that particular product. How much raw material, how much direct labour, how much expenses, and how much does it cost to make the product. That's the important consideration. Fixed costs are seen as irrelevant as far as decision making is concerned. This is because fixed costs do not alter despite the level of activity. They simply remain constant. So fixed costs are not taken into account. They're there irrespective of what decisions are made. There's also the fact that fixed costs can be difficult to apportion when multi-product firms exist. It's very difficult to apportion fixed costs, but when There are several different plants within the company, several different even departments, and they all have varying fixed costs. It's very difficult to apportion the costs. It's very difficult to work this out. So, generally speaking, the fixed element is excluded from short-term decision making. In other words, the management simply look at how much does it cost to make the product, that particular product. In other words, look at the variable and direct costs, look at the direct labor, the direct materials, and so on, and figure out how much does it cost to make that product, ignoring the fixed costs. These can be dealt with through the addition of the overhead, the addition of the markup, I apologize, the addition of the markup to the marginal cost, and that will be a contribution towards the fixed costs. When eliminating fixed costs in this process, it means that decision making will not be based on profit but on contribution. So the decision making is all about making a contribution towards the overheads, and then going on, once the overheads are paid for, going on to make a contribution towards profits. And the more that's sold, the more profits will be generated. The overheads will have been apportioned and met and paid for. Now the contribution will start to generate a profit. Marginal costing is based on sales, variable costs and contribution, and that's what we should bear in mind. It does not deal with fixed costs. So fixed costs are not relevant in this case. Now the view of marginal costing is that fixed costs will always stay the same despite the volume and sales produced. Hence, the sale of an extra item will cause revenues will increase because more has been sold. Variable costs will increase for that extra unit produced, because the more that's produced, the more variable cost, the more raw materials will be required to make the extra unit, the more labour will be required, the more additional expenses, whatever they are, will be required. So variable costs will increase, but revenue will increase because the item will be sold. And the item sold, remember, I keep saying this, but remember, the item sold will cover the variable cost, the marginal costs, plus the markup, which is a management decision later. Once they know what the marginal costs are, they will add a markup, and that markup will start to bring in extra revenue. That's where the revenue will increase. Profit will also increase from the extra amount received from contribution. So this markup will make a contribution towards the overheads, and later on, as I said earlier, we'll go on to make a contribution towards profits. So profits will start to increase as more is sold. If the amount of volume falls, say by 1 unit, this will then impact on the amount of profit earned due to the level of a decrease in the amount of contribution. So if sales start to fall off, then of course the contribution towards the overheads and towards the profits will also start to fall off. Profit measurement should be based on total contribution, because fixed costs do not change despite the sales volume. So profit measurement is based on total contribution. And just to drive it home yet again, management concentrates on marginal cost, how much does it cost to make a particular product, at a markup. The markup makes a contribution towards the fixed overheads. But once the fixed overheads are paid for, then that contribution is towards making a profit. Now, if sales fall, clearly that contribution is lost. When units of products are produced, this would then have an impact on the variable element rather than the fixed cost, and this is shown in the contribution per unit. So we now have a fairly clear picture of how companies generate profits, and through this technique, marginal costing, management are only interested in the variable costs for a particular unit of output. They work out what the cost of that product is, and they then add a markup to it, which is the contribution towards overheads and towards profits, and the more they produce, the more profits they make. Take a table. Here we've got revenue on the first line. The revenue is from the sales of the item, less the variable costs, whatever the variable costs are that is included in the item. So the raw materials, the various components that have been added on, and perhaps the labour, the direct labour that's been used. So less those variable costs, and that gives us the contribution. And then we take away the fixed costs, whatever they are, and that gives us the net profit. So the contribution here is direct material, direct labour, variable production overheads, variable selling and distribution overheads. So that's what we get in terms of contribution. And in terms of net profit, we have production overheads, selling overheads, distribution overheads, administrative expenses. And once these have been paid, we have the net profit. When performing a marginal cost statement, most often calculations are done on a unit cost basis rather than in totals. So that's one way of presenting the information we've got on the screen at the moment. There are other ways, and there are other videos that you could look at that will give a different perspective of this. So, contribution analysis. Well, contribution is equal to revenue minus variable cost. In contribution analysis, the revenue generated must be greater than the variable cost. If the revenue generated is less than the variable cost, then each item of production will add to costs. The more it produces, the worse the situation will become. So this would indicate that each product or service divided by the provided by the business is able to contribute to its fixed overheads. When the business starts covering its fixed overheads, then profits will be made, and that's what I've been saying earlier. Contribution is a very useful tool in decision making. It helps businesses decide which products or services are generating more profit. So it's a very useful tool because management can now look at the products it's producing and look at the marginal cost, the cost of making those particular products, look at the markup it's able to add on. In other words, work out the contribution that that product is making towards the overheads and towards the profits. So it knows which products are the star performers and which products are not doing so well. So it's a very useful tool for management in decision making. It also answers to basic questions such as, is the product making a positive contribution to the company's performance? Or would it be best to cease production? It's absolutely important that the management know if a product is generating a profit, or if it's making a contribution towards the overheads and profits. If the management know what the marginal cost is, the marginal cost is for a particular product, then it knows the price in the market, and if the price in the market is less than the cost of making it, then cease production. If the price in the market is more than the cost of making it, more than the marginal cost in other words, then the management know that in making the product and in selling it, that they will get a contribution towards their overheads and later on towards their profits. In fact, the more they sell, the more contribution they will get. It really asks the question, are we making the most of our resources? Is it possible to switch resources around? Because perhaps some marginal costs are very close to the market price, in which case the company really ought to be looking at developing new products or cutting costs in some way, or it needs managerial attention to try and rescue the situation. Because the gap between the market price and the marginal cost, if that is not significant and positive, then it does need intervention. Are we increasing contribution by producing more products? I mean, that's an important one to know. It clearly follows from what we were just saying earlier. If management know that they are getting a contribution of products, then clearly the more they make, the more they will, the greater their ability, I should say, to cover their fixed overheads. But if they're not making a lot of each one, if the marginal cost of production is very close to the market price, then as I said, they will need to intervene and make decisions about whether to end that particular product run, to try and cut the costs, or try to vary the product, or they'll have to do something about the situation, because the product is not significantly adding to its contribution towards the overheads or to profitability. Now, the advantages and disadvantages of marginal costing. Well, it's easy to understand. Management simply looks at the product and tries to work out how much did it cost to make the product. How much is the raw material, how much labour is in it, how much energy did it use in electricity. It doesn't concern itself with the fixed cost, just how much did it cost to make the product. And then look to adding a markup to get the contribution to the overheads and the profits. So it's easy to understand. It avoids the need of apportioning fixed costs. So it goes down a different route to some parts of management accounting, which will try to apportion the fixed costs. This one avoids this by simply trying to work out the marginal costs, and then the more it makes with a given markup, the greater the contribution towards the overheads. So it doesn't actually apportion the fixed costs. There's no need to do it. It provides a basis for pricing decisions. It supplies managers with a baseline. It tells them exactly how much it costs to make the product, and therefore they can use that as the starting point for pricing. They know they have to charge more because they need the markup on that marginal cost price. They need a markup to make the contribution that they need to cover the overheads and to make a profit. So they know what they can charge. They can perhaps see similar products in the market or at a certain price, and they know how much they're producing for, and therefore they're able to set the price. The contribution of each product is identifiable. They're able to work out how much each product is contributing towards the profitability of the business. It provides solutions for short-term decision making. I say short-term decision making, if it's adopted by the business, it's short-term in the sense that the managers are able to monitor what's happening in the marketplace in terms of sales and what the competitors are doing, but they're also able to monitor their own costs in the short run. But the long run could be seen as just a lot of short runs added together. So although we say it provides solutions for the short run decision making, this could be moving from one time period to the next, but essentially using the same approach. It covers all additional costs, because once the contribution is coming in, once it's selling and making that contribution towards the fixed overheads, then all of the additional costs are covered. So the business knows what its overall costs are, providing it's selling the product and the markup is generating the contribution that we're talking about, then it's starting to cover all of the additional costs. Some costs may be hard to class as variable and fixed. So there are issues in marginal cost pricing that need careful attention of management accountants. Some elements may be considered as fixed or variable, it depends. For example, labour used in the production of the item. Is that a variable cost? It sounds like the more items produced, the more workers are required, but sometimes it's important for organizations to employ teams of workers, because to run a particular production line requires so many workers, because they all do various tasks along the production line. So it's difficult to work out exactly what the variable cost of labour is included in the product. So sometimes there are issues about trying to work out if something is variable or fixed. And sometimes also that's related to time. It's argued by economists, for example, that in the long run everything is variable, but in the short run we could have fixed costs. Pricing of products may not be accurate. It may not be accurate for some of the reasons we just said above. Pricing of products may it's based on accurate figures coming from the cost accountants about how much it costs to make that particular product. And the more that's then produced with the given markup, the greater the contribution. But if the original costing of the product was not accurate, the company could find itself in a dangerous position where it's selling the product at under the cost of production. Take examples. Well, let's say we have a company here called Premier Limited who specializes in making precision nuts, perhaps nuts out of particular material, let's say out of titanium or particular types of nuts, let's say. The nuts have a variable cost of, let's say, £2 each and a selling price of £6 each. Now during August there were no opening inventories and production for the month was, let's say, 10,000 units. Fixed costs for the month were, let's say, £5,000 for production, £2,000 for administration, sales and distribution. So a very simple example here. You're required to calculate the contribution and profit for June using the, or for August I should say, for August using the marginal costing approach. So bearing in mind it's all for August, and that's a typo at the bottom of the slide. The nuts have a variable cost of £2 each, a selling price of £6. In August they produced 10,000 units. The fixed costs were 5,000 for production, 2,000 for administration, sales and distribution. Work out the marginal costing, work out the contribution and profit using marginal costing. So we'd set this up as follows. We'd say that the revenue here is £60,000. It's 10,000 units, as I said, at £6,000. I'll just go back to the previous slide for a moment. It's well worth just making a note of that, so when you're looking at the next set of slides you've got it in front of you as well. Anyway, we've got 10,000 units at £6 each, so the revenue is £60,000 in August. Less variable cost, which is £20,000. The variable cost we were told was £2 per unit, and there was 10,000 units produced. So less the variable costs, which is £20,000. So the contribution, in other words, is £40,000. So revenue minus variable cost is equal to contribution. So 60,000 minus 20,000 is equal to 40,000. £40,000. So now we know what the contribution is. Less the fixed cost. The fixed costs were £5,000 and £2,000, which is £7,000. In other words, the net profit is £33,000. So the contribution, which is £40,000, less the fixed costs, which is £7,000, equals £33,000. The contribution per unit, well, the contribution per unit is equal to the total contribution divided by the total number of units. So the total contribution here is £40,000 divided by 10,000 units, which is £4. So that's the contribution of each nut produced, £4. And the profit per unit, well, it's the total profit divided by the total number of units. So the total profit here is 33,000, that's the net profit, divided by 10,000, the total number of units produced, which is £3.3. And that's how we would work out an account based on contribution using marginal costing. So it's been a long class, 90 slides. I'm going to leave it at that and ask you to go back over the class a few times, make your own notes and get a clear understanding of what's meant by marginal costing. There are other videos on this available on the course, so please look those up as well and make some notes from some of the PDFs and some of the material supplied. But that's all we're going to deal with here, so thank you for watching.